So this lecture is the first part of Fool's Gold. And Fool's Gold is not quite as easy to read as the number, but it's a little more technical. But you're going to learn a lot about how and why people committed fraud during the real estate bubble that burst in 2008. It's going to show incentive, rationalization, and opportunity. And when those things combine, you see more fraud. Now, there weren't as many frauds like there was in the technology bubble that went to court, like Enron and WorldCom and HealthSouth and Tyco and Adelphia and all those. But there was a lot of mortgage fraud, and then there were a lot of companies that were doing suspicious things, like Lehman Brothers and Bear Stearns, that ultimately went bankrupt. And in the case of Lehman Brothers, it's pretty clear that they were committing fraud with their Repo 105 transactions. So this case is really good at illustrating the pressures that banks put on themselves through the amount of debt that they took on and other things. And then we'll have some really good discussions about, is taking on too much debt really fraudulent? Well, making bad business decisions isn't necessarily fraudulent, but what we find is that puts pressure on you when you make a bad business decision or take on too much debt to fraudulently report your financial statements. And so to start, we need to talk about what a derivative is. You guys have probably heard derivatives, but derivatives, like it says here, is a form of insurance. It's a financial instrument that derives its value from some other asset. So an example of that is a futures contract. So like Southwest Airlines, for example, one of the reasons why they were so profitable, even when oil prices were going up and other airlines were extremely unprofitable, is because they entered into futures contracts. So 5, 10, 15 years ago, they contracted with somebody else to provide them oil at a price that they felt was reasonable. So 15 years ago, maybe they contracted for oil prices at a certain price, and then oil prices spiked, but they were still using these futures contracts to buy oil at a lower price. And so when they sign those futures contracts, the contract goes up in value and goes down in value as oil prices go up and down. So if you've contracted to buy oil at $100 a barrel in the future, maybe 5 years from now, and during that time oil goes up to $120 a barrel, then your contract has value. And the value is derived on the value of something else, which is the barrels of oil that you're actually going to buy in the future. Right? So even though the contract itself is just a piece of paper, it derives its value from the thing that it's contracting, which is oil prices. So during the 1970s, the Black-Scholes option pricing model came around. So Black and Scholes at the University of Chicago developed this model that you could use to measure things that have volatility, like stock options. And there was a lot of volatility in the markets at the time. So there were oil shocks, dramatic inflation during the 70s, high interest rates to help bring down that inflation. And we went through the 70s when we talk about the numbers. And it was sort of a rough time. And to really understand like how we got to where we were in 2008, we need to understand these derivatives and primarily what an interest rate swap is. And an interest rate swap is an agreement between two parties to exchange cash flows in the future. So what happens is banks often borrow money at variable rates, but they loan it out at fixed rates. So they borrow money at variable rates from other banks, but they'll loan it out as like a 30-year fixed rate mortgage. And the problem that raises for banks is when not oil prices, but interest rates go up and down. So if they're borrowing at variable rates and interest rates go up, and they go up above the fixed rate in which they loaned it out at, then they lose money. So the way that they can protect themselves against interest rate fluctuations is to hedge against interest rates with an interest rate swap. So in the example here, Bank A agrees to pay Bank B LIBOR plus 5.5% at the end of each year. So that is LIBOR plus 5% is a variable rate because LIBOR is going to go up and down. And when you add 5.5% to that, that's a variable rate that goes up or down. And then Bank B agrees to give Bank A 9.5%. So Bank B is swapping a fixed rate for a variable rate. And so if a bank has a lot of variable rate loans, they might want to swap out variable rate for fixed rate. So the way that they do that is they just contract with another bank to pay them interest on some nominal amount or some notional amount. So they may say, okay, let's agree to pay interest on $1 million. So I'm going to pay you interest at some variable rate at the end of the year, and you're going to pay me interest at some fixed rate at the end of the year. That way, one bank is hedging, maybe has too much fixed and wants some variable rate, and one bank has too much variable rate and wants some fixed rate, so they swap. So in this case, here's an example. To hedge interest rate risk, a bank could structure an interest rate swap and pay 9.5% and receive LIBOR of 5.5% on $1 million, which is what we just talked about. So if the LIBOR rate goes up, then the floating cash flow, which is LIBOR plus 5.5%, shows your floating cash flow at 3% is $85,000. So in that case, the fixed cash flow is $95,000. So you're better off at the variable rate. But as the variable rate goes up, if it goes up to 5%, now that's greater than the 9.5%. So then you're better off with a fixed rate. So the fixed rate interest at 9.5% actually pays less than the variable rate interest. So as the variable rate goes up, the fixed rate cash flow looks increasingly better. Right? And then as interest rates go down, the fixed rate cash flow looks worse. Right? But if you have too much variable, you might want to switch to fixed rate. So you just negotiate with another bank that you're going to pay interest on some notional amount to the other bank. So one will switch variable, one will switch fixed. And that's good for the banks because one has too much variable and one has too much fixed, and they're able to swap variable for fixed interest. And so it helps offset losses for variable or for interest rate fluctuations. So the question is, there's banks out there that are doing this. So if Bank A just contracts with Bank B to do an interest rate swap, nobody's really aware of it. Just Bank A contacted Bank B, and they just did an over-the-counter transaction. So they didn't go through a market. They didn't go through an exchange to make that transaction. Like when two banks sell stock to each other, they probably go through an exchange. So if they buy maybe they buy General Electric stock, so one bank has some excess cash, so they buy some General Electric stock. When they do that, they go through their broker and they go through an exchange, and the exchange has rules. And then the exchange knows how much General Electric stock is traded on any given day. But when banks do interest rate swaps, for example, and they're over the counter, so Bank A just calls up Bank B, there's no exchange that they transact on, then nobody knows that this interest rate swap is happening other than the two banks. And so if people are taking on excessive risk by speculating on interest rates or by speculating on gold futures or oil futures, nobody's really aware of it because nobody's regulating it. There's no exchange that says, hey, Bank A and Bank B are swapping interest. And maybe they're swapping too much interest and they're putting themselves at risk. But regulators don't know that. Right? So unless these derivatives are traded on an exchange, and the regulators don't know how much of this is going on, and they don't know if it's supposed to be regulated or not. So regulators are uneasy with derivatives because, as it quotes in the book, part of the problem with deciding what to do about derivative regulation was that there was so little specific data available about the growth of the business. So regulators didn't actually know how much interest rate swapping was going on out there because it was being done over the counter, or OTC, and not on an exchange. And when things are done on an exchange, so if a client asks their broker to buy General Electric stock, and then that broker forms a contract with another broker, said, hey, I'm going to give you money, you provide me the stock, and they transfer the money, but the other broker doesn't transfer the stock, then the exchange is going to step in, and the New York Stock Exchange is going to tell the broker, hey, you have to make good. And because they're members of the exchange can make sure that the trade happens and penalize people that don't fulfill their side of the trade. Right? So, and it also, so it's sort of an orderly process to sell stock, and it records the volume of trade, so you know how much General Electric stock or any stock is being traded throughout the day. And the deals are standardized. So the stocks come in certain stock certificates, right? You know how much you're going to pay for each share of stock, right? And it's all traded on the exchange, and it's all regulated by the exchange and the SEC. But when you do things over the counter, so one bank just agrees to swap interest with another bank, they just have to draw up the contract. There's no standardized interest rate swap contract that they refer to. They just come up with their own notional value. They come up with their own measurement of the variable interest, and then they just agree with each other to make this interest rate swap. Now, the problem for regulators is they don't know when that's happening. Right? So it's good because it allows customized deals. They're not standardized deals, but they're not transparent, and there's no central data gathering system. And so consequently, there's no regulator and there's no protection against counterparty risk. So if Bank A contracts with Bank B and they swap variable for fixed interest on a notional value of $1 million, and Bank B doesn't pay, there's nowhere to go. There's no exchange to make it right. That'll fix it. So there's no protection against counterparty risk. The interesting thing about derivatives, though, derivatives have been going on for 1,000 years. So farmers, 1,000 years ago, were trading derivatives. And they think, well, what do they mean by that? Well, the reason why farmers would do it is farmers would need money at the beginning of the year to plant their corn or their wheat or whatever. And they didn't know how much, if they're going to have a bumper crop, if they're going to grow a lot of wheat or a lot of corn that year. And so what they would do is they would contract with a merchant to buy their wheat or to buy their corn ahead of time so that they knew how much money that they were going to get. So if there was like a bumper crop and all of their competitors, all of the farmers out there grew a bunch of corn that year, well, that would drive down the price of the corn. And so they may not make that much money that year. So to hedge against that, they would contract to sell their corn ahead of time. That way they knew, okay, I'm going to plant because I know I'm at least going to get this much money when I sell my corn in the future. So there's been derivatives, futures contracts in the commodities market for years. And so there is a commodities future trading commission that regulates commodities derivatives, right? Futures contracts and commodities. But there wasn't regulator for interest rates and other things. And so there was some threatening in the 80s that regulators were actually going to crack down on interest rate swaps and other types of derivatives. And so what happened was an International Swaps and Derivatives Association formed in 1985. And it was a group of bankers, the Salomon Brothers, BNP Paribas, Goldman Sachs, JP Morgan, and others came together and said, hey, well, we don't want to be regulated, right? So we're all going to agree. We're going to hash out some legal guidelines for these over-the-counter deals so that regulators can provide some comfort that we've got this under control, that you don't need to regulate us. Because regulators are saying, we've got these Commodities Future Trading Commission that's been regulating the commodities derivatives for years. Why don't we just have them also regulate interest rate swaps and other types of derivatives, these exotic derivatives that banks are creating? And when they did a survey in 1997, a couple years after they developed this International Swaps and Derivatives Association, they found that the notional value of interest rate and currency swaps is about $865 billion, which is a lot of money. Now, again, they're not trading $865 billion. They're trading interest on that $865 billion. And one's trading variable, one's trading fixed. And they're not actually trading the full amount. There's just a difference between the variable and fixed rate one bank would send to the other. So it's $865 billion notional value, but that doesn't mean that's how much money was going back and forth. In 1992, so the head of the Fed in New York was telling the New York Bankers Association, I'm concerned. And he said, given the sheer size of the derivatives market, I have to ask myself, how is it possible that so many holders of fixed or variable rate obligations want to shift those obligations from one form to the other? So why is this happening? And if it's so big, and he starts to wonder, maybe there's something I need to be aware of, that the Fed needs to be aware of, because maybe we need to get in and regulate this so that people don't get themselves in trouble. And then a group of 30, which are highly influential group of economists, academics, bankers, got together, and they said, you know what, don't worry about this. We've got this under control. We're going to promote better international financial cooperation. You don't need to regulate us. We're going to get this under control. So again, it sounds a lot like the number. where people don't want to be regulated. We don't need the SEC. We don't need people looking down, looking over our backs. And so what happened was J.P. Morgan had been using what they called value at risk calculations at the end of each day. They were trying to figure out what's their value at risk. And it was a methodology to figure out how much, what the riskiness of their balance sheet was. And they encouraged all banks to adopt their formula for calculating risk and using this value at risk concept. And everybody said, all right, yeah, we'll do that. And then they said, we're going to teach our CEOs and CFOs of our banks how we're creating these derivatives and how exactly they work, because they're pretty complicated. We'll make sure that senior management understands, what these interest rate swaps are, how big they are, and how much money is actually at risk. Because if there's a spike in interest rates, some banks could get really hurt if they had swapped variable or fixed for variable. They could really be in bad shape. So we'll let our senior management know how much value we have at risk, and everything will be okay. So the government doesn't need to intervene. We don't need any type of clearinghouse. We don't need an exchange. Just sort of leave us alone. Right? And regulators, absent any reason to believe that fraud's occurring, then regulators sort of stay out of the way, because there's not any reason for them to step in. There's no public outcry. Say, look what happened. You guys need to step in and regulate this market. So it doesn't appear that anything's really gone wrong. Banks have agreed to sort of keep things under control, and regulators step away. The interesting thing that was, remember from the number, is 1994, Greenspan raises interest rates because he sees that the economy is starting to go full tilt, and he gets a little nervous and he raises interest rates a little bit. Well, when he does that, all these banks had done these interest rate swaps. That variable rate goes up, right? And so if you had switched fixed for variable, now all of a sudden you're in a bind because you're paying out variable rates, and you weren't anticipating this rate spike by Greenspan, and basically all heck breaks loose. And some banks are really struggling because they've swapped so much fixed for variable that any spike in interest rates puts them in a bind. So because of this, because these interest rate swaps obviously are fluctuate greatly based on spikes in interest rate or hikes in interest rate, and we've seen that some banks lost a lot of money, then there was some concern among regulators that maybe we don't have this under control. Maybe we should need to be regulating these interest rate swaps. So what happens is 4 bills are introduced into Congress to regulate derivatives. And they say, you know what, we've already got the regulators who regulate commodities derivatives. Why don't we just put interest rate swaps in there as well? But the ISDA and others leap into action. They lobby. Greenspan, as we know, is a free market thinker, is an efficient market thinker, so he's not big into regulation. And then you had others say, like, derivatives are like NFL quarterbacks, they get more credit and blame than they deserve. And things calm down in the markets, right? We know from 94 to 99, the market takes off. And so there's no more shocks to the interest rate market, and things just subside, and these bills are shelved, and derivatives don't get regulated. So then in 1994, we have Hancock at J.P. Morgan. They have a party, and they get a bunch of smart J.P. Morgan traders together. And they're trying to think of how they can make more money for the bank. And they recognize that they can hedge interest rates. They've already sort of figured that out, that they can do these interest rate swaps. And so they think, well, what's the other risk that we have at the bank? And they think, well, the other risk that we have, rather than interest rates going up and down, is that the people that we loan money to, our clients, might default on us. So we have a risk related to interest rates. We also have a risk related to default. So is there a way to manage or to swap our default risk? So if we loan money out to General Electric and they don't pay us back, and we'll lose money if they default on us. So how could we mitigate that risk? And so what they thought was, if we can swap interest rates, maybe we could do credit default swaps. So what would happen is, we'll talk to another bank and say, hey, or another individual and say, hey, do you want to insure us against a default swap? So if General Electric, we loan them $1 billion and then they default on the loan, then you pay us the difference. And so these other investors think, well, maybe that's not so much of a bad idea. Because I don't think General Electric is going to default on the loan. All I have to do is insure against their default. So the bank that loans General Electric the money, they just pay an insurance premium to a company that essentially becomes an insurer. And then if General Electric does default, because they've been paying in for default insurance from this third party pays the default. So they thought that's brilliant, right? We essentially now protect ourselves against default. And just to give you some examples of how that can work, JP Morgan in 1993, they have this big client, which is Exxon. And Exxon Valdez, the tanker crashes up in Alaska, and they have a $5 billion fine to the government. It's going to cost a lot of money to clean the ducts and everything that are dirty, and clean up all the oil out of Alaska. And so they come to JP Morgan and say, hey, we need essentially a $5 billion line of credit. Now, JP Morgan thinks, well, Exxon's one of our biggest clients, and we want to loan them the money, but we don't want to actually loan anybody $5 billion. That's too much risk, too much money to put at risk with one client. We don't think Exxon's going to default, but at the same time, we don't want to give anybody a loan that big. That's put too many of our eggs in one basket. So they think, how could we give Exxon the loan that they want and maintain good customer relations without taking on the risk that they might default? Well, they come up with like a brilliant idea, like we've talked about. It was like, maybe we can get somebody to insure us against a default on Exxon's loan. So they talked to the European Bank for Reconstruction and Development. And they have a bunch of regulation on them, and they can't take out, right? They can't make risky loans. So consequently, without much risk, they're getting very little return on their assets. So JP Morgan comes to them and says, you know what? We don't really think Exxon's going to default, but we don't, and they want a $5 billion loan. We don't want to loan them the $5 billion because that's going to put all of our eggs in one basket. But we actually wouldn't mind loaning them the money if somebody else could insure us against default risk. And so, Mr. European Bank for Reconstruction and Development, how about we do this? We write a contract, and we'll pay you a premium. We'll just give you money, and all you have to do is insure us against a default by Exxon on this credit line that we're going to extend to them. And the European Bank for Reconstruction and Development, they say, you know what? That's actually a pretty good idea, because I don't think Exxon's going to default. I can analyze Exxon's financial statements. I can assess whether they're a candidate for default. They look pretty healthy. They've got a lot of cash in the bank. They're making a lot of money. I think it's very unlikely they're going to default on this line of credit. So I'm willing to insure them, insure you against default by Exxon. So you just pay us that premium. That premium is just going to go into our pocket. We don't have to do anything. It's just free money. And the only risk to us is if Exxon does default, and we think that's very unlikely. So the European Bank for Reconstruction and Development is really happy. They get a fee from Morgan to insure Morgan against default for Exxon. Morgan's happy because they're able to loan their big client and maintain $5 billion and maintain good client relations. And Exxon's happy because they got the loan. So it looks like they've done a really good thing here. And in theory, they have. They've done a really good thing. So JP Morgan wanted less risk. EBRD wanted a little bit more risk. They got some return for taking on a little bit more risk. JP Morgan got to satisfy a client, and Exxon got the loan that they needed. So in this case, everybody wins. So there's nothing wrong with this credit default swap. So just so you can be clear, the interest rate swap, as we were talking about before, now we're swapping default risk. So JP Morgan thinks, well, this is brilliant, because the other risk that we have other than interest rate spikes is that our customers don't pay us back. That's default risk. And now we figured out a way to insure against default risk. So then they go to the government and say, hey, I know we've got this regulation around us because we're a bank and we have to have so much cash in reserve in case people default on us. We can't loan out everything. We've got to have some cash. So we've got these capital requirements where we have to maintain so much cash in reserve. But what if we can insure against default risk? Then can we reduce the amount of cash that we have to hold on hand? And if the more money they can loan out, the more money they can make. right? So they want to lower these reserve requirements, these capital requirements. And so the Fed eventually says, you know what, if you get insurance against default, we'll let you lower your capital requirements so you can loan out more of your money. So JP Morgan's like, great, that's exactly what we want. Now, the problem that they have is now that they figured out how to do it, that's great. But there's probably not going to be another situation where there's Exxon who's got $5 billion, who wants a $5 million loan, and a European Bank for Reconstruction and Development who's willing to insure that $5 billion loan. So what we normally have is just a bunch of other clients. So we might have 20 different clients that we've loaned money out to. So we've loaned money out to General Mills, we loaned money out to Ford, we've loaned money out to Microsoft, we've loaned money out to maybe Goldman Sachs and other banks. We've borrowed money from us. So we've loaned a lot of people money. And none of it's the size of Exxon, where it's like $5 billion. But we would like to get insurance against default against any number of these people. So what they figure out that they can do is just stack these loans together and get one person to insure all the loans together. And if they stack these loans together, they say, you know what, that actually diversifies away the risk. Because maybe General Mills defaults, but Microsoft and Goldman Sachs and other clients will actually pay. So in reality, maybe one person defaults, but these are all blue chip clients. They're not all going to default. So by diversifying, make a portfolio of loans, that's even less risk that a potential insurer wouldn't mind taking on, right? Because the European Bank for Reconstruction and Development, they were taking all the risk related to one client, which is Exxon. But if you gave them a portfolio of clients and say, insure us against these portfolio of 20 firms, that's even less risky that all of them together are going to go bankrupt. That just seems unlikely. So what they do is they pool these credit default swaps into a bundle of securities, and then they issue bonds based on the cash flow. So it gets a little more exotic. So what JP Morgan will do is say, okay, we've got $100 million of loans out there in this portfolio of companies that we've loaned money to. And what we want to do is we'll sell bonds, and the loan payments that we get from these 20 customers will pay the interest on these bonds that we take in that we sell to clients. So the clients give JP Morgan $100 million. They buy $100 million worth of bonds from JP Morgan. And the clients also understand that when they loan JP Morgan this $100 million, that money can be used to insure these portfolio of loans where the interest coming from these loans is paying the interest to the clients on the bonds. So if anybody defaults in this portfolio of loans, then JP Morgan is going to take part of the $100 million that the client loaned them and through bonds to pay back the default. So the clients, the bondholders, are at risk for the default on for any defaults in this package of 20 loans that JP Morgan has out. And so, but the clients understand that. So they not only get an interest rate, get an interest on their bond, they also get like a premium for insuring a portfolio of loans that JP Morgan wants to insure. So the clients get a pretty good yield on these bonds because, like I said, they not only get the interest rate, they also get the insurance premium for letting their $100 million bond be insurance against these potential defaults. But the clients aren't really that concerned because they can look at the portfolio of loans that they're insuring, and they say, hey, this is Microsoft, this is Goldman Sachs, this is General Motors, this is Ford. These folks are not going to default on us, and we can analyze what the credit risk is. So I'm perfectly happy getting my interest rate on the bond plus an insurance premium for insuring these companies because I think it's very little risk that they're going to default. So this works out great, and the clients and the bondholders think this is great for us because we get a pretty good yield on this bond, more than just interest rate, more than just regular interest rates. We get the premium on for insuring this corporate debt, and so we get a good yield. JP Morgan's happy because they've essentially insured themselves against default risk. So if any of their companies in this portfolio of 20 companies defaults, then they get their money back. So they're not really at any risk. They can loan out even more money. So they feel like everybody wins. So it gets even more complicated than that. And this is what we do in Wall Street. We take a good idea and then we just beat it to death and make it more complicated until it turns into a bad idea. So this is where we're headed. So they create that scenario, and then they decide, okay, we're going to create synthetic collateralized debt obligations. And so we're going to issue bonds, but these bonds are going to come in with tranches. So, and the bondholders can pick which tranche they want to be in. So we'll call it junior, mezzanine, and senior tranches. So the folks in the junior tranches, they're the ones, if like the first default, if there's a package of corporate loans, of 20 corporate loans, the first one to default, if one of those defaults, it gets paid out of the junior tranche. So the bondholder who bought into the junior tranche, they got a higher return than the senior tranche because they got a higher premium because they were going to be the first ones that are going to be on the hook in case one of those corporate loans defaulted. And then if the junior tranche gets wiped out and there's mass defaults in this corporate loan portfolio, then it goes to the mezzanine tranche. And they get a little bit lower return than the junior than they gets, but a little bit higher return than the senior. Then if the mezzanine tranche gets used up, then the senior bondholders, they're the ones that have to make up the difference. So the senior bondholders are really not insuring very much because it's unlikely that if you have a portfolio of 20 blue chip companies that there's going to be mass defaults, that it's going to use up the junior and mezzanine tranche, and then you're going to get hit with some defaults. So they don't get as much of a premium, so they don't get as much of a return, but they're also taking on very little risk. So like I said, they make this portfolio of collateralized debt obligations even more complicated by dividing up into tranches. And then they make it even more complicated. So this is where we're headed when we create opportunities to commit fraud, is we add layers and layers of complication, which creates opportunity. So what they do is, how this process works is the bank says, you know what, I don't want to just insure, $20 million worth of loans. I've got a portfolio of loans that's to all these corporate customers. That's a total of $9.7 billion in loans. And I want to insure default on that whole $9.7 billion worth of loans. So what I'm going to do is I'm going to set up an offshore shell company, a special purpose vehicle. And this special purpose vehicle is going to sell $700 million worth of bonds to investors. So they're going to give bonds to investors. The investors are going to give the special purpose vehicle $700 million. Then with this $700 million, it's going to be insurance against any defaults on the $9.7 billion of loans that this bank's holding in their portfolio. And so keep in mind that they did not actually insure the whole $9.7 billion. They only insured $700 million. But they thought, these are all corporate clients. They're not all going to default. A few of them might default. And so we don't know which of the $9.7 billion are going to default, but we're going to insure up to $700 million of losses of this $9.7 billion. So the investors, when they buy the bonds and give the SPV, the special purpose vehicle, $700 million, they know that their money, the $700 million that's sitting there, is going to insure default on any one of these loans in the $9.7 billion loan package that the bank holds. But to buy that insurance premium, they're going to pay a fee to the special purpose vehicle. So they're going to pay an insurance premium to the special purpose vehicle that's going to get passed along to higher interest rates to the bondholders, to these investors. So these investors, just like we talked about before, are getting a good return on these bonds. They're getting an interest rate plus a premium for allowing their money to be insurance against the bank's against default for the bank's loans. And then they divide, the special purpose vehicle divides up the bonds into junior, mezzanine, and senior tranches like they did before. So keep in mind that they said this $700 million that investors loans, the bonds that they buy, that they loan to the special purpose vehicle, it doesn't insure the whole $9.7 billion. It only insures $700 million worth of default loss. But banks think, there's no way I'm going to lose more than $700 million on blue chip bank loans to these blue chip clients of $9.7 billion. And since these are all good corporate clients, the bonds that the SPV sells gets pretty high ratings, AAA ratings, because they think it's extremely, extremely unlikely that any of these blue chip corporate companies are going to default on any of their loans. And so, but the bondholders get the bond interest rate that's actually pretty high because it includes some insurance premium in there as well. And so they feel like sort of everybody wins in this scenario. The banks get the default risk off their books. The investors get the high yield, and they're willing to take on some risk. So they get the high return, they get the high interest rate that includes the insurance premium. So everybody wins. The banks insured themselves against default loss. Investors get higher premiums, and they're willing to put some of their money at risk related to the default, to potential defaults, but they don't think it's going to happen. But they're willing to take that risk. So the banks shifted the default risk over to investors, and investors feel like they can handle it, and they use the special purpose vehicle as the middleman. So again, this seems pretty complicated, and it is complicated. And like I said, this is going to create opportunities for people to commit fraud. So now, once they realize they can do this, the next step, obviously, is what about mortgages? So these bonds are insuring corporate loans. What about a bunch of individual mortgage holders, just families living in homes? Could you insure against mortgage defaults? So that's where we're headed. The one thing to keep in mind is, like we said, the special purpose vehicle did not, it only collected $700 million worth of in cash to insure against $700 million. All they had was $700 million to pay out in defaults. If there was a catastrophe and a bunch of blue chip companies defaulted on their loans, the banks still had some risk because they only have $700 million worth of insurance on $9.7 billion of loans. So if their defaults rise to be above $700 million, then they're still on the hook. That $9 billion is still on the hook. So that's called super senior risk. That's above the senior tranche. So the senior tranche is all wiped out, and now the bank's on the hook for the rest of the defaults. Well, they thought, Hancock at JP Morgan said, it's ridiculous to worry about the eventuality of massive defaults. If the corporate sector ever suffered a tidal wave of defaults large enough to eat through $700 million funding cushion, then the disaster probably would have already wiped out half the banking system. There was no point, it argued, in running a bank on the assumption that the financial equivalent of an asteroid would devastate Wall Street. So we only need to get $700 million worth of insurance on default. We're never gonna have more than $700 million worth of loan defaults to these blue chip corporations. If it did, then that's just chaos, and it's the equivalent of an asteroid striking the Earth. So we're not going to worry about that. So the Fed says, well, I know you're not worried about it, but we're worried about it. An asteroid could strike, so we're not going to loosen the capital requirements. You still have to maintain the same level of capital on your books, even though you've gotten $700 million worth of insurance on $9.7 billion of loans. So then the banks thought, well, who would insure us against this super senior risk? Because we want to reduce our capital requirements. So they think, AIG. AIG is the one, because they're an insurance company and they're used to this type of thing. They're used to getting a premium and managing risk. So they go to AIG and say, look, we've got these $9.7 billion of corporate loans. We're insured up to $700 million in losses. But this other $9 billion we're not insured against. So if an asteroid hit the Earth and wiped out all these blue chip corporate companies, and we had more than $700 million worth of losses, then we're actually on the hook for $9 billion. And AIG says, okay, well, I'll insure you. I'll insure that $9 billion. Well, that's super senior risk. It's extremely unlikely that the asteroid's going to hit the Earth and that they're going to have more than $700 million in losses in their corporate loan portfolio. But AIG says, for as much as 2 cents on the dollar, we'll insure that $9 billion. Well, 2 cents times $9 billion is still a lot of money. In the meantime, as they're negotiating this insurance for the AIG, the Fed flips their position and says, you know what? We thought about it some more in the super senior risk. Yeah, you're right. An asteroid's not really going to hit the Wall Street. So you can hold less in reserves even though you haven't actually gotten default for that 9 billion. And so the banks are like, great, let's do this. Right? And so then, now that they've got this concept figured out that they can insure against default, the next step is, what about mortgages? Could we, instead of insuring corporate loans, can we insure mortgages? So we'll take out a portfolio of 20 or 30 corporate loans and insert 1,000 mortgages in there. And then we can insure against mortgage defaults. And JP Morgan's thinking, I don't know if that's such a good idea. The corporate loans, we have a long history of analyzing corporations and knowing what their default risk is like. Individual mortgage payers, we don't really have a history of assessing what's the likelihood that individual mortgage payers are not going to pay us. And so we really don't know like what the risk is that mortgages might stop paying. Indeed, an asteroid could hit the mortgage market and wipe out a bunch of homeowners, and then they don't pay us, and then we could be in a bind. So then they didn't have the data to be able to estimate what the default rate was for mortgages. They thought, I don't know if it's such a good idea to create the same scenario, but substituting mortgages for corporate loans, or corporate loans for mortgages. But they do one. So a bank in Germany convinces them to do the same scenario for mortgages. And they put a package together. They sell bonds, and these bonds insure the bank against mortgage defaults. And they call it a bistro. And then they stopped doing it. They just say, we did it one time, but we just didn't really feel that good about it because we didn't have the data. We didn't know what the likelihood that these mortgages were going to default. And so we weren't even sure how much premium we should pay the bondholders. Everything just doesn't feel right. So they don't do it. Now, we also have to keep in mind, as we learned from the number, this is the era of deregulation. So JP Morgan's underwriting bonds, they're underwriting equities, stocks. Then Morgan Stanley buys Dean Witter. Citibank merges with Travelers, who just bought Salomon Brothers. And then in '99, we know that Glass-Steagall was repealed, so investment banks and commercial banks could combine if we wanted to. And there was a sense that the financial world was becoming flat. It's morphing into one seething, interlinked arena for increasingly free and fierce competition. So that's where we're headed. And then, as you remember from the number, long-term capital management explodes, and Greenspan saves the market. If you remember, he puts together a consortium of banks, and these banks help LTCM unwind their position, even though they're bankrupt. It calms the panic in the market. And then there's this perception that Greenspan will always save us, so we can take on more risk, and it doesn't matter if we implode like LTCM, Greenspan will save us. There was, in 2000, there was this Commodities Futures Modernization Act that basically said swaps were not futures or securities, and therefore they couldn't be regulated by the commodities regulators or the SEC or anybody else. So now we passed a law saying derivatives don't need to be regulated, they can't be regulated. And then JP Morgan merges with Chase, so they become an investment and commercial bank in 2000. So we're going to see that the market's going to take what was a good idea, which is interest rate swaps and then credit default swaps. They're going to substitute credit default swaps and put mortgages in instead of corporate loans, and then all hacks are going to break loose. So that's the end of part one. I'm looking forward to talking about part two.